Ladies and gentlemen, there is a number sitting inside the World Gold Council's own data right now that most people watching gold headlines have never seen. Central banks reported 16 tons of net gold buying to the IMF in the first quarter of this year. 16 tons. That's the kind of number that makes a headline writer say the central bank gold rally is over. Except the World Gold Council, using shipping data, refinery flows, and the Shanghai Gold Exchange, put the real number for that same quarter at 244 tons. Not 16, 244. That gap, 228 tons of gold that moved into sovereign vaults and never showed up on an official balance sheet, is not a rounding error, it's a message. And once you understand who's sending that message and why, you're going to look at every ounce of gold and silver you own completely differently. So let's talk about where we actually are right now, because the price action alone tells a story most people are getting wrong. Gold is trading around 4,170 an ounce as we speak. That's up roughly 25% from a year ago. But here's what a lot of the loud voices online won't tell you. Gold hit an all-time high above $5,500 back in late January. So the metal you're looking at today is actually sitting more than 20% below its own record. Silver tells an even wilder version of the same story. Silver's at about $62 right now, up close to 70% year over year, but down from levels well above 70, and by some accounts touching past $80 earlier this year. So if your first reaction to that title is, wait, didn't gold and silver already have their moment? I want you to sit with that question, because the answer is more interesting than yes or no. And by the end of this, you'll understand exactly why a pullback of this size, after a move this large, might be the most important buying window of the entire cycle rather than the end of the story. Here's why this matters right now, this week, not in some abstract future. We just got a jobs report that changed the entire conversation. The US economy added only 57,000 jobs in June. Economists were looking for something closer to 110,000. That's not a small miss. That's less than half of what was expected. Unemployment actually ticked down to 4.2%, but that's because people left the labor force, not because hiring accelerated. Now, here's the part that should get your attention if you hold metal. Going into that report, futures markets were pricing something like a 67% chance the Federal Reserve would need to raise interest rates in September, not cut, raise, because energy prices tied to the conflict in the Middle East had put upward pressure on inflation expectations. After that weak jobs number came out, the probability of a hike collapsed to under 50%, and gold and silver both caught a bit immediately. The Fed chair himself said this week that inflation expectations have eased while still reaffirming the central bank's commitment to price stability. That's the tightrope the Fed is walking right now. Weak labor market on one side, energy-driven inflation risk on the other. That tension, that exact tension, is rocket fuel for precious metals, because it means the Fed cannot aggressively tighten its way out of an inflation problem without breaking an already fragile labor market. And metal doesn't need rate cuts to rally, it just needs the market to stop pricing in rate hikes. That's exactly what happened this week. Now, if you notice something happening quietly underneath the daily price swings, it's actually more important than any single jobs report. I'm talking about what central banks are doing with their own reserves. This is not retail investors buying coins at a local shop. This is sovereign nations, some of the most well-informed buyers on the planet making a multi-year, multi-decade decision about what a safe asset even means anymore. Let me take you back to February of 2022, because that's the actual origin story of everything happening in the gold market today. When Russia invaded Ukraine, Western governments froze roughly $300 billion of Russian central bank reserves that were held abroad. $300 billion gone. Not stolen exactly, frozen, locked, made inaccessible overnight by the stroke of a political decision made in Washington and Brussels. And every single reserve manager on the planet, and every finance ministry, and every central bank from Warsaw to Beijing to Astana learned the same lesson in that instant. If your reserves are dollar denominated and sitting in a foreign jurisdiction, your safety depends entirely on your political relationship with the country controlling that currency. That is not sovereignty. That is dependency. And gold sitting in your own vault in your own country cannot be frozen by anyone else's foreign policy decision. It cannot be sanctioned. It cannot be devalued by another government's printing press. That single realization is why official sector gold buying roughly doubled after 2022, climbing to around 1 ZUN tons a year compared to roughly 500 tons a year in the decade before that. And this year, that trend hasn't slowed down. It's just gotten harder to see. China's central bank has now bought gold for 18 straight months, 18 months in a row of net additions. Poland has been the single largest buyer this year, adding gold as part of a plan to push its reserves towards 700 tons, driven by very real security concerns sitting right on NATO's eastern border. Kazakhstan, Uzbekistan, the Czech Republic, all steady, consistent accumulators. And in the World Gold Council's own survey of central bankers this year, 89% of them said they expect global central bank gold reserves to keep rising over the next 12 months. 89%, that's not a fringe opinion anymore. That's close to consensus among the people who actually manage sovereign wealth for a living. But here's the number that I think is the real headline, and it's the one most financial media completely glossed over. China's official gold reserves, the number they report to the IMF, sit at around 9% of their total foreign reserves. Compare that to the United States or Germany, both sitting around 69%, 9% versus 69%. Now, China's total foreign exchange reserves are enormous, north of $3 trillion, mostly still parked in dollar assets like U.S. Treasuries. So even a modest shift, even China deciding to move from 9% gold to 20% gold over the coming years, would represent one of the largest sustained buying programs gold has ever seen in a single market. And remember that quarter I opened with? Chinese net gold imports in the first quarter of this year alone came in at 317 tons, nearly triple the pace of the prior quarter, while the People's Bank of China's officially reported purchases stayed at a trickle. Somebody in China is buying enormous amounts of physical gold that isn't showing up on the central bank's books. That's either strategic underreporting to avoid telegraphing the move before it's complete, or it's happening through state-linked entities that don't report the same way the central bank does. Either way, the direction of travel is not in dispute. Now let's talk about silver, because silver is playing an entirely different game than gold. And if you don't understand that difference, you're going to misjudge everything that happens next. Gold is at its core a monetary asset. Roughly 95% of its demand comes from jewelry and investment. It's a store of value, a hedge, a form of savings that predates every currency on earth. Silver is a split personality. About 60% of annual silver demand is industrial. Solar panels, electric vehicles, electronics, medical technology, and increasingly something that wasn't even a meaningful demand category 5 years ago. Artificial intelligence infrastructure and data centers, which use silver in high-efficiency electrical components and thermal management systems. So silver isn't just a monetary hedge, it's a direct bet on the physical build-out of the modern economy. And here's where it gets structurally interesting. The silver market is now run on a supply deficit for 5 consecutive years. Demand has been outstripping mine supply by somewhere between 160 and 200 million ounces annually. And silver, unlike gold, is mostly mined as a byproduct of other metals like copper, lead, and zinc. That means when silver prices spike, miners can't simply flip a switch and produce more of it, because the decision to open a new mine is driven by copper or zinc economics, not silver economics. Supply is stubborn, structurally stubborn. That's part of why silver moved from under $30 to well past $70 in 2025 alone, a gain of over 130%, and why some analysts now believe the market still hasn't fully priced in how tight the physical deficit actually is. Would you buy silver at this level knowing it's already up nearly 70% over the past year? That's a fair question, and I want to answer it honestly rather than just tell you what you want to hear, because there is a real risk sitting inside the silver case, and it's called thrifting. As silver prices climb, solar panel manufacturers have every financial incentive to reduce how much silver goes into each panel or to shift towards silver-free technologies like cadmium telluride thin film cells. JP Morgan's own commodities team has flagged this directly, saying the biggest long-term risk to silver isn't a lack of demand, it's demand destruction from industrial users engineering silver out of their own products because the price got too painful to ignore. That's a real dynamic. It's happened with other commodities before. So no, silver is not a one-way trade, and anyone telling you it hasn't done the work. Let's talk numbers, because I promised you real research, not hype. JP Morgan's global research team, one of the more measured voices in the space, currently forecasts gold averaging around $6,000 an ounce by the final quarter of this year, with $6,300 a possibility for 2027. That is a meaningful move higher from today's 4170, roughly 44% from here, but it is not a tripling. I want to be very clear about that distinction because the title of this video uses the word triple, and I'm not going to insult your intelligence by pretending every serious analyst on Wall Street agrees with that number. They don't. JP Morgan itself has acknowledged that gold is currently stuck in what their head of base and precious metals strategy called a technical no man's land, trading above its 200-day moving average, but capped below its 50-day moving average, with investor interest cooling even as the structural central bank story remains intact. So where does the tripling thesis actually come from, and is it credible? It comes from a smaller, more aggressive camp of analysts who aren't modeling a normal cyclical rally. They're modeling a monetary regime change. Their argument goes something like this. If de-dollarization accelerates rather than stabilizes, if even a handful of major reserve holders like China move meaningfully higher than 9% gold allocation, if government debt levels force more currency creation across multiple major economies simultaneously, and if a geopolitical shock, whether that's an escalation in the Middle East or elsewhere, triggers a genuine flight to hard assets rather than an orderly one, then gold's move from 2022 through today, which has already taken it up over 200% from its lows, could simply keep compounding rather than mean revert. On the silver side, at least one well-known voice in the space, Alan Hibbert at Gold Silver, has put out a target in the $175 range for silver, which, depending on your entry point, does approach that tripling scenario. I want to be completely transparent with you. That is a bold minority forecast. It is not the base case of the major banks, but it is not fantasy either, because the mechanism behind it, sovereign reserve managers walking away from a currency-based monetary system that concentrated too much power in too few hands after 2022, is already observably in motion. The question isn't whether that mechanism exists. The question is how far it runs before it exhausts itself. Is this rally sustainable, or could it be a trap? Let's steelman the bear case honestly, because I owe you that. The dollar could stabilize if the Fed does eventually need to raise rates to fight energy-driven inflation, and a stronger dollar is historically a headwind for dollar-priced metals. Western ETF investors who chased gold and silver hard on the way up could reverse into sustained outflows if momentum stalls. And JP Morgan specifically warned that a slowdown in central bank buying combined with ETF outflows would be a real headwind, not a hypothetical one. Silver's industrial demand could soften if a global slowdown actually materializes, since silver, unlike gold, is tied directly to the health of the real economy, not just fear and safe haven flows. And technically, gold sitting below its 50-day moving average while above its 200-day average is exactly the kind of indecisive, choppy pattern that can chop up both bulls and bears before it resolves in either direction. None of that is me talking gold and silver down. It's me being honest that no asset, including this one, moves in a straight line, and anyone who tells you it will is trying to sell you something, not inform you. If you're someone who wants clear, research-based gold and silver analysis instead of market noise dressed up as certainty, make sure you're subscribed, because that's exactly what we do here week after week, following the actual data rather than the headlines built to get clicks. Here's what I think this actually means for people holding physical gold and silver right now or thinking about starting a position. The central bank story is not speculation anymore. It's happening in real time. It's documented by the World Gold Council's own data, and it represents the single largest, least price-sensitive buyer in this entire market. When a sovereign nation buys gold, it is not day trading it. That metal effectively leaves the float permanently. Combine that with a silver market running its fifth consecutive supply deficit, driven by structural, hard-to-reverse industrial demand from solar, electric vehicles, and now artificial intelligence infrastructure, and you have two metals with genuinely different but mutually reinforcing tailwinds. That doesn't guarantee a tripling. I want to be honest with you about that one more time before we close this out, but it does suggest that the 20 to 25% pullback we've seen from this year's highs in both metals looks a lot more like consolidation inside a longer structural move than the end of one. Smart money, meaning the reserve managers who move in tons rather than ounces, kept buying straight through the correction earlier this year. That tells you something about where conviction actually sits, separate from where headlines sit. I genuinely want to hear your take on this. Do you think central bank buying keeps accelerating from here? Or do you think this is closer to the top of the cycle than people want to admit? Do you believe the tripling scenario for gold and silver is realistic within the next few years? Or do you think that's a step too even with everything we just walked through? Put your honest answer in the comments. I read them and I'll pull some of the best arguments on both sides into a future video. Before you go, if this kind of grounded source check breakdown is useful to you, like genuinely helps this reach more people who are trying to think clearly about their money instead of reacting to whatever's trending and sharing it with one person who holds metal or who's on the fence about it, costs you nothing and might save them from making a decision based on noise instead of data. So here's the one thing I want you to walk away with today. This isn't a story about a number on a screen going up. It's a story about how the world's largest, most sophisticated financial institutions redefined what a safe asset even means after watching $300 billion get frozen overnight in 2022. That redefinition doesn't reverse in a few quarters. It plays out over years, sometimes decades, and it's still in its early to middle innings, not its final one. Whether gold and silver actually triple from here is genuinely uncertain, and I won't pretend otherwise. But the forces pushing in that direction, sovereignty dollarization, a genuine structural silver deficit, and a Federal Reserve trapped between a weakening labor market and energy-driven inflation risk are real. They're documented, and they're not going away because of one strong or weak jobs report. Keep watching the data, not the noise, and I'll see you in the next one where we're going to dig into exactly what happens to gold and silver if the Fed is actually forced to choose between fighting inflation and protecting the labor market, because that decision, whenever it comes, might matter more than anything we talked about today.